Hello friends, it's Chris Lee, CPA here, back with another video for you. And today we are going to look beyond the 401k plan and start talking about a niche retirement vehicle that is, far and above, the 401k and its tax savings capacity. So the question is sometimes, I've maxed out my 401k, my SEP IRA, or some other retirement plan, and I still have too much taxable income and not enough retirement savings, or simply that we're trying to get income out of our highest tax bracket years. And so if you're a successful business owner or a high earning self-employed professional, you might be hitting ceilings on traditional retirement plans, and you kind of need a bigger bucket to fill for those assets that you're willing to put into a retirement plan. So today we're going to talk about the cash balance pension plan. So this allows owners to legally stash away hundreds of thousands of dollars more than just the typical 401k, which leads to massive tax deductions for a business. So we're going to talk about what it is, how it works, and the critical rules you need to know as you start kind of exploring this as a potential option for yourself. So the first thing to ask is, and to answer is, what is a cash balance plan? Sometimes you'll hear a cash balance plan or a CD plan, and we just need to know what these terms mean. So when we think about retirement plans, they come in two flavors. There's a defined contribution plan, which is when an employer is making a set contribution to a retirement account on behalf of its employees. And so the real risk that employee bears with the retirement dollars is on themselves and on their market asset selection within that account. So it presents a specified amount that's going to be contributed, much like, this is like a 401k or a SEP IRA or SEP IRA, that sort of thing. However, when we talk about a cash balance plan, it looks more like what we call defined benefit plan, which basically means that it's legally structured to pay a specific predetermined retirement benefit. So a specific amount to be paid over the terms of retirement. So the cash balance plan looks slightly more like a defined benefit plan than it does a defined contribution plan, but in reality, it is treated as a hybrid plan. So it sits kind of in the middle of, a defined benefit plan and defined contribution plan, but it leans more towards the defined benefit plan. So here's how it works. If you are a participant of a cash balance plan, you're credited with a hypothetical account within the plan. It's not a real brokerage account. It's simply just a bookkeeping entry. Each year, the plan credits your account with a paid credit, usually a percentage of a salary. So this might be 5% compensation. So the plan holds an account for you. Each year, you get a credited amount of, a percentage of your salary put into the plan, and then your account is credited with an interest credit, which is either a fixed rate or a variable rate tied to a specific index. This could be, something like the 1-year treasury bill. So the big difference between a 401k and a cash balance plan is that the plan's actual investment performance, the gains and losses on the real money funding the plan, do not directly affect the account balance that you are credited with. So this hypothetical account that's in there is not bearing the market risk. What actually happens is the risk is borne by the employer sponsoring the plan, the company funding the plan. This is what makes it more of like a defined benefit plan. The company bears the risk of the performance, because a defined benefit plan is to say, we will pay you this much benefit in retirement. So the benefit is defined for the plan participant. So that's fundamentally what we're looking at. So at retirement, you usually take your final hypothetical balance in the cash balance plan as a lump sum, or convert it into a lifetime annuity. So, and because it's a defined benefit plan, the promised benefits are typically going to be insured by the Pension Benefit Guarantee Corporation up to legal limits. So that's the thing is that you're going to have a specified amount at retirement, and that risk is borne by the employer, not the plan participant. So the power of the cash balance plan is its ability to generate massive tax deductible contributions. And this is the case, especially for older, higher earning, business owners. So unlike a 401k where contributions are capped annually, the cash balance plan's maximum contribution is determined by the amount needed today to fund the future promised benefit. Since older employees have fewer years until retirement, the required annual contribution is much higher. So there's less time for those dollars to grow within the account. And so because of that, there's a lot more upfront funding that must go into it. So this makes it ideal for self-employed professionals, doctors, CPAs, consultants, law firms, where the owners have higher amounts of income and are often older than their staff. And then small businesses with stable cash flow, a cash balance plan, might be a good option since it requires it. It could be an option. Cash balance plans requires mandatory annual funding, so the business must be financially stable. If it is not a stable business, this is probably not the plan for you because it is mandatory, the contributions to the account. The employer doesn't have discretion to say, oh, we're not going to do profit sharing this year or whatever. And then the real magic is that you can combine it with traditional 401k plans. So when you run a combo plan, this is, you can contribute to your 401k and then pile on hundreds of thousands of dollars more into your cash balance plan. It is not uncommon for, highly compensated owner in their 50s or 60s to contribute and deduct, over $250,000, $300,000 annually in a combined structure. That's, a huge reduction in your taxes, right? Because you get those as deductions against the ordinary income. So to summarize, the two main advantages associated with this is that there are huge tax deductions. This is, the primary tax benefit. The primary benefit is that it is a tax advantage opportunity here. So the contributions are tax deductible as a business expense, directly lowering, the tax liability for either, the C corporation that's paying the taxes, or, if it's a pass-through entity, the pass-through entity owner. So, and then you're also getting the benefit of accelerated savings. It's an efficient way to make up for lost time in retirement planning, especially for your business later in life. The cons of this is that unlike a profit sharing plan, the cash balance plan requires annual funding. If the plan assets underperform the guaranteed interest credit, the amount that's credited account every year, the employer must make up the difference with a mandatory catch-up contribution. So you can't skip it in a bad year. You just got to find the dollars. Since this is a defined benefit plan, it requires an actuary, a licensed actuary, to perform the annual calculations and certifications. And the administrative complexity is significantly higher than a 401k for that reason. In a tax filing sense, because it is functions a lot like a qualified retirement plan, you still have the 5,500 filing requirements once plan assets are over $250,000. Which usually happens in year one anyway. Or, there are also other rules with defined benefit plans anyway. And then there are the non-discrimination rules. So you cannot set up this plan just for yourself. Federal law, specifically ERISA, is going to require that you provide proportionate benefits to significantly broad base of your employees under the non-discrimination testing rules. So if you've got several employees, this might not be, and you're not particularly generous, or you're not in the mood to have such a significant amount of funding into these programs or the retirement benefits for your employees, this is not the thing for you. So this plan is mathematically designed to benefit older, higher earning employees most, but you still have to contribute on behalf of your staff. So this is the cost of the plan's massive tax advantages. And so if you've got a number of employees on staff, this plan is greatly generous to them, but it's highly cost, it carry the high cost to you, the cost of compliance. So that is something that must be considered. So I actually had a client recently ask me, like, oh, another CPA recommended a cash balance plan to me as like a retirement. This was a client that was, we're kind of in the prospecting phase with. And you've got 15 people on staff and you're kicking out $700,000 of profit a year. Yeah, it sounds nice. Unfortunately, you're going to have, a huge burden in funding your other staff members, right? Like it's not just you that you have to pay for into this plan, it's other people because of the non-discrimination testing rules. They said this for you is not something I would recommend. And turns out this individual is, I wouldn't say they're necessarily fee sensitive, but potentially fee sensitive. But that is, if you're opposed to paying really high professional fees to execute a plan, the cash balance plan is also not for you. The cost of compliance is very high, and so it might not be a fit purely for that reason. So now let's think a little bit of some of the other rules that kind of go into the cash balance plan. So the legal framework for a cash balance plan is governed under a trio of federal laws. So you've got the Employer Retirement Income Security Act, ERISA, you've got the Internal Revenue Code, and then you have Age Discrimination in Employment Act under the DOL. So for compliance, the 3 areas of focus for the Department of Labor is going to be the vesting for all benefits accrued under a cash balance plan, including benefits from conversion, and employees must be fully vested after 3 years of service. So this is faster than many traditional pension plans and is a key employee protection. You have to have a notice of reduction if the employer amends the plan in a way that significantly reduces the rate at which employees earn future benefits. The employer must provide a written notice at least 45 days in advance, and the no wear away rule on conversions. If your company converts a traditional pension plan to a cash balance plan, you cannot reduce the benefits that participants have already earned. The law is going to require participants to receive the sum of their old benefit plus their new cash balance benefit. This prevents wearing away period, which is where participant accrues no new benefits until the new account balance catches up to the old accrued benefits. So it's really just protecting employee rights. So understanding these rules is complicated. These are just like the primary rules that come with cash balance plans, but these plans are highly regulated, and compliance failures are punitive. The Department of Labor, which is part of this regulation process, like I said, is punitive in when there are errors in executing these plans, because they want to ensure that it never happens again. So this is when remaining compliant is where your advisors earn their fees, because missing the step is extraordinarily costly. So to wrap this up, a cash balance plan is not like some quick and simple solution. It's not something you can implement like very, very quickly. You need to make a calculated choice. But with that said, it's one of the most powerful tax advantage tools available for high income business owners looking to save aggressively. So it is a defined benefit plan. A cash balance plan functionally is, in thinking of takeaways, it's a defined benefit plan that appears to look kind of like a 401k account. It gives you massive tax deductible contributions far exceeding traditional limits. And it's especially effective when combined with a 401k, and it requires an mandatory annual funding and sophisticated actuarial and administrative oversight. So if you're a high earner trying to reduce your tax burden and supercharge retirement savings, the cash balance plan is a strategy to explore. So you cannot set this up on your own. This is going to be an advanced strategy that's going to take a conversation with your CPA, your tax professional, your financial advisor, and an experienced, third-party administrator who specializes in defined benefit plans. This is, like I said, this is an advanced tax strategy to implement, and it has risks for doing it wrong, and it's very costly to administer properly. However, if this is the right fit for you, that it can have a lot of tax benefits. So I leave those ideas to you. If you want to talk specifically about your own tax needs or circumstances, feel free to book a call in the link down in the video description, and we can talk soon. So back with you soon with another video. Take care. Bye-bye.